we talk about the potential for a rate hike, then in about several weeks' time, the data comes out and it's off the table again. So why do they keep putting it on the table, Jeremy? What is the objective here? Just to bring in some two-way risk? What's it all about?
Yes, I think you've probably hit the nail on the head there, that I think they don't like having a market with a unidirectional bias. They want to have still some degree of installation of two-way risk. You're absolutely right that if you go back when Mr. Carney did make that reference to 7%, we've seen substantial downgrades into what is the equilibrium rate of unemployment. The bank are now assuming that it's around 4.5%. Well, of course, we've already moved below that, and the rate that the labour market is advancing, we could easily find ourselves somewhat nearer to 4% by the time the Bank of England update their forecasts in early November. So there is this sort of push me pull you nature of the bank's thinking and the bank's language, and that is causing some degree of uncertainty in the financial market perspective. But clearly, if the bank is mindful of the influence of inflation over the medium run, by allowing or tolerate just a modest repricing of sterling higher, that is limiting or alleviating some of those medium-run inflationary pressures. So certainly sterling nearer 135 than 125 will alleviate some of those commodity price influences which have really been driving up goods prices, which are at a 5-year high in that CPI report on Tuesday.
Hey, David Kelly, what does coming months mean for you?
What is the coming month?
Yeah, I mean, do you feel like that's December? Do you feel like that's next year? What are your base case for that?
Well, on the Bank of England, we believe that they're not going to move until next year. I think that the Federal Reserve will begin to normalise policy starting in October. They'll try and normalise their balance sheet. We still think there'll be a rate hike in December, but we're seeing a common problem with central banks around the world. Narrow is broken all over the place. I mean, we should have seen wage inflation in the United States. We're at 4.4%. We should have seen on the unemployment rate. We should have seen wage inflation in Japan. They're below 3%. But what's happening is, this very easy money is not pushing up wages, is not pushing up basic core inflation. What it is doing is it's pushing up asset prices, and that is a reason for all central banks to think about normalising here. I do think the Bank of England has got a special problem with this sort of tropical storm of Brexit hovering, uncertain, before them. It's going to cause problems. We just don't know how much of a problem for the British economy, and that it does give them a special problem because they want to keep sterling low going into that. But in general, I don't think we should look at wage inflation as the trigger, because these very low rates around the world, they're obviously not going to cause wage inflation. It hasn't happened yet, but they are distorting asset markets more and more, and that's dangerous.